Look at the stock market today. You'll see millions of retail investors chasing the exact same 3 or 4 semiconductor stocks, desperately hoping the artificial intelligence bubble never pops. But behind the scenes, a quiet crisis is brewing. The real wealth migration of the AI era isn't happening on the front pages of the financial media. It's happening in the shadows. In this Wealth Asura Explainer, we're going to dissect exactly how institutional capital is front-running the greatest physical bottleneck in modern technological history.
There's a stark contrast between the frantic, euphoric mindset of the retail trader and the cold, calculating accumulation executed by Wall Street. While the public gambles on consumer-facing software applications, smart money is targeting a highly specific deadline, July 2026. By that date, the biggest constraint to AI won't be code. It won't be chips. It will be the procurement of physical baseload electricity.
Consider this chilling metric. A single AI-generated query requires up to 10 times the electrical power of a traditional search engine. To put that into perspective, just generating a few images of a cat on your computer could power your home's LED lighting for an entire week. When you scale that multiple across billions of daily global interactions, the physical infrastructure of the modern world simply buckles.
Act 1. The Secret AI Bottleneck. Software might live in the cloud, but the cloud lives in massive, concrete buildings that require staggering amounts of energy. The hyperscalers, companies like Microsoft, Meta, and Google, are quietly panicking right now. To train their next-generation models, their data centers demand 24/7 continuous operation. They can't rely on the wind blowing or the sun shining. They require an unprecedented, unbroken stream of clean, baseload energy, and the modern grid is utterly failing to provide it. This critical missing asset is exactly where the real institutional money is flowing.
Act 2. The Diagnostic Asset.
Take Constellation Energy, trading under the ticker CEG. You have to stop viewing this company as a standard, slow-moving utility. In the current market paradigm, Constellation is a premium, institutional-grade technology asset. As the absolute largest producer of carbon-free nuclear energy in the United States, they hold the exact physical monopoly that the hyperscalers so desperately need.
The mechanics of this timeline serve as a masterclass in institutional foresight. Just 1 year ago, Constellation operated as a standard utility provider. Then came the catalyst. Microsoft bypassed silicon entirely and went directly to the power source. Today, 100% of the electricity from the 3 Mile Island reactor is allocated solely to fuel Microsoft's AI data centers. They didn't buy chips, they bought a nuclear plant's entire output.
This mechanism is known as a Nuclear Power Purchase Agreement, or PPA. It's a massive, multi-decade contract designed to secure continuous, unbroken electricity. When Wall Street algorithms process a PPA of this magnitude, they aren't looking at a simple utility bill. They see decades of guaranteed, high-margin revenue locked in by one of the wealthiest tech monopolies on the planet.
The market reaction was absolute. Constellation Energy stock experienced a violent, vertical institutional re-rating, jumping a massive 80%. Wall Street instantly realized that clean, reliable nuclear power is the ultimate toll bridge for the AI boom. While the retail public absorbed the volatility of highly speculative tech startups, the institutional elite generated massive fortunes simply by owning the utility that powers them.
Act 3. The Second Layer Cycle.
Professional portfolio managers anchored the strategy in historical precedent. During the California gold rush, the most consistent, low-risk wealth wasn't made by the individual miners panicking in the dirt, hoping to strike it rich. The true multi-generational fortunes were amassed by the merchants who set up shop at the base of the mountains, the ones selling the shovels, the pickaxes, and the denim jeans to those desperate miners.
This market breakdown reveals exactly where algorithmic funds are systematically hunting for fractional downside risk. On one side, Nvidia, Microsoft, and Google are the miners. They're locked in a brutal, hyper-expensive race for dominance. On the other side, the second layer. The utilities, the copper transmission line manufacturers, the liquid cooling infrastructure providers. They are the ones selling the shovels. They supply the mandatory physical resources required for the miners to even compete.
This cold, logical framework presents the ultimate hedge. Second-layer infrastructure is vastly superior to first-layer software speculation for one very simple reason. You cannot code your way out of a power outage. Even if a highly anticipated AI software completely fails to find a market, the servers running its training models still consumed gigawatts of power. The utility bill must be paid. The infrastructure provider wins, regardless of who wins the software war.
Act 4. Your 3-step action plan.
Observation without execution is utterly useless. For the Wealth Asura viewer, this is how you transform understanding into a direct structural advantage. You must stop acting as exit liquidity for Wall Street. To invest with the calculated precision of an institution, you need to follow 3 explicit steps: cap exposure, scan for bottlenecks, and systematically accumulate. Let's break them down.
Step 1 is pure risk mitigation. You must immediately cap your exposure to any technology stock trading above a 75 price-to-earnings ratio that is driven primarily by retail hype. Buying the absolute peak of the tech euphoria cycle is mathematical suicide. The algorithms are out there looking for liquidity to sell into. Do not offer them yours.
Step 2 requires targeted reconnaissance. You need to identify the exact physical resources required to make the AI ecosystem function, and hunt for companies that mirror the Constellation Energy mode. Your target should be owners of clean baseload electricity, producers of the intensive copper wiring required for data centers, and engineers of advanced thermal cooling systems. You are exclusively looking for entities with monopolistic pricing power over these physical choke points.
Step 3 is the execution protocol. Once you identify these high-moat physical asset stocks, remove human emotion entirely. Do not attempt to time daily chart movements or trade around macroeconomic news cycles. Instead, set up an automated programmatic monthly allocation. By systematically buying physical assets, you quietly align your personal capital with the largest institutional spending cycle in human history.
The era of blindly chasing overvalued software is over. The institutions have already moved on to securing the power grid of tomorrow. The only question remaining is your strategy. Will you continue chasing the volatile euphoria of the crowd? Or will you step into the shadows and silently accumulate the physical infrastructure that makes the future possible? Subscribe to Wealth Asura and let's execute systematically.